This
I'm
meeting
gonna
is being
share.
recorded.
I'm gonna share again. All right. So even that price goes up or down, that farmer has secured that sale for 7,000 francs CFA per pound. So that's what hedging is. So you hedge against price fluctuations. And the next actors are speculators who are nothing but me and you, individuals
Mhm.
who trade their own funds in the futures market. And then we also have portfolio managers who are experienced, certified financial investment managers who take the responsibility of investing assets of a mutual fund, exchange traded fund, or a closed-ended fund. So if you have like 529 accounts for your kids, most of these 529 accounts are managed by experienced portfolio managers. That's their job.
Okay.
So when you're investing, let's say if you put $250 in your child's 529 account, they
Mm-hmm.
use that money in the market. They use that money, they make more money out of that money. That's why you have the compounding interest rate that they give to that 529 account.
I see.
So they make money and then they give you back money.
Okay.
So these are the key players in futures trading. The next thing I want us to talk about is the elements of a futures contract. So every futures contract has it's based on an underlying commodity. Like I said earlier, it can be an energy related stuff, it can be a metal, it can be a foreign exchange, it can be an equity, it can be an interest rate or an agricultural commodity. And then the quantity is also fixed. The quality is fixed. The delivery time and location is also fixed. If I have a contract to deliver 10 kilograms of cocoa to you on December 15, that will not change. The only thing
Okay.
that is variable is the price. That's where hedging takes an advantage. All right.
Okay.
And then we have contract symbols. Contract symbols. Every future has a symbol that you use to trade, just like with stocks. Tesla, you're gonna see TSLA, Nvidia, NVDA, XTI, just like that. So futures also have symbols, and the future symbols, they are not just symbols, but they have meanings attached to it. For
Okay.
example, the ESU4, let's say you're trading uh, the E-mini S&P 500 contract, which is SPY. You know what SPY is, right?
No.
So SPY is S&P 500 index. It's a group of the top companies that are traded in the S&P 500.
Okay. All right.
And you see the ES is the contract symbol for the E-mini S&P 500. And then the
Hmm.
U it stands for the monthly symbol of the contract, which is the delivery month.
Hmm.
And
Okay.
then this last four is the year, and in our case, 2024, 8-4. So for 2025, this same contract, let's say for example, this contract was in January, it's going to read ESF5
Wow.
for
Okay.
January. For February, it's going to read ESG5 for 2025. If it's 2026, it's going to read EF56 for 2026.
Hmm. Wow.
That is clear, right?
That's clear, but that needs a lot of cramming.
It's not a lot of cramming
I'm just
because
in the chat.
you see the ES, right? The ES doesn't change. That's the contract symbol.
Okay. The
So if you want
month.
to trade SPY and you go to Webull, you put ES, it's gonna show you ES for the current month and everything.
Okay.
Yeah. But it's important for you to know how they come up with those symbols, because some people will be confused. Oh, why is it ES F4 this month and ESG4 next month?
That's right.
Yeah, that's why it's good for you to get this foundation.
Okay.
Not many people get to this detail when they are teaching futures.
Okay.
But I try to do it in a way, I try to get very granular so you understand the ins and the outs. The
Okay.
least things I want you to know,
Mhm.
just like the most important things as well.
Thank you.
Any questions on this?
No.
All right. Um, the next thing here is prop firms. Prop firms are nothing but companies who provide you with leverage for you to trade for a profit. So just like the headline is saying, they supply their traders with education and the capital required to execute many trades per day. I'll give you an example. If you're
Okay.
trading Nasdaq today,
Mm-hmm.
Nasdaq is very expensive. It's like one contract is like, I don't know the exact price, should be like 27,000 or so.
Wow.
So
For
some
one.
people put their money for one contract. Yeah, just give me 1 second. I'll be right
Okay.
back. Sorry.
Sure. Okay.
All right, I'm back. So
Okay.
very few people have that money to put and trade futures, right?
That's right.
So these prop firms, they give you the money. They can give you 25,000. They can give you 50,000. They can give you 100,000. They can give you $1 million to trade, but they have
Okay.
a percentage. For example, the prop firm that I use, it's called Take Profit Trader. We see it. So they take 20% of your profit, and then you take 80%.
Okay.
But you can cash out your money every day, and you're trading with their money.
Oh wow.
Yeah, so that leverage is the advantage. That's what the next point is saying. By using the capital resources of PropShop, traders gain access to more leverage than they would if they were trading on their own account.
Yeah.
Trust me, there's an advantage, you know. I have
Yeah.
an account right now which is all my own money. The advantage is
Okay.
that you have more flexibility. If you put $100,000 in a futures account right now, you
Mm-hmm.
can trade as you want. But with prop firms, if they give you, for example, they give you 100,000, if you, if it happens to be a bad day when you do not have a stop loss and you lose $2,000 from that 100,000, that account gets frozen.
What?
Yeah,
Really?
yeah, that account
But
gets
if you
frozen.
lose $2,000 from 100,000, they freeze
Yeah,
the account.
you
Wow.
cannot lose 200. You cannot lose 2,000 in a day. Yeah,
Wow. So you have to
yeah,
set
that
this
you
stop loss
cannot
very.
lose 2,000 in a day. Yeah.
Okay.
So if you lose 2,000 a day, you have to pay. You have to reset that account with $100 and then pay $199 for renewal of that account.
Wow. No way.
So that is the advantage, with your own $100,000 account. Maybe a trade can go against you, you lose 2,000, that's fine. Tomorrow you're gonna trade again, maybe you're gonna make 8,000 or so.
Yes.
But that's what prop firms do. And there are a few examples here. We have Take Profit Trader, which is what I use.
Okay.
We have Tradify, we have Apex, we have my Founder Futures, Tick Trader, we have UProfit, we have Bullnox, ETF, we have Trader, Trade Day. All of these have their advantages and disadvantages, but the best one that I have seen is Take Profit Trader. They don't charge you too much taxes. They take just 20%, and you can take your money to your bank account every blessed day. They pay you every day.
Okay.
Some of these other ones, they pay you once a month. Some pay you once every 2 weeks. But you can finish trading today. You make $2,000. You send 1,800 into your bank account.
Wow. Okay.
You come in the morning, you trade again. You make 1,000. You send 800 into your bank account. They take their 200.
Wow. Okay.
So I find it very, very, very nice to use, and I recommend that you use it to Take Profit Trader.
All right.
All right. The next thing here is, how does a trade work with futures? So we have what we call contract size. Each futures contract has a standardized size that doesn't change.
Okay.
So that size is fixed. For example, if you're trading in agriculture, you want to trade corn, 5,000 bushels of a specific type of corn, type and quality of corn, remains 5,000 bushels for a contract. And if you're trading the indices, for example, E-mini, S&P 500, the futures contract is $50 times the price of the S&P 500 index. I'll show you an example so you understand, right?
Yes.
This is what I trade. This is the index that I trade. I trade QQQ, this one.
Okay.
You see it, right?
Yes, I see it.
NASDAQ.
Okay.
I trade NASDAQ, and this is NASDAQ today. NASDAQ is 513, right?
Yes.
Multiply 513.84 times 50 and let me know what it is.
But that's a lot of math.
It's very easy. 513.84 times 50.